Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 69. Don't ring the bell. What do I mean by that? Well, here in just a minute, you're going to find out. So, with the market as crazy as it has been over the past week, month, year, there just seems to be no relief in sight. We had the producer price index come out this week. We had the CPI, consumer price, come out this week. And so the numbers were not good. Inflation is still around. There is a lot of negativity out there. So we're going to discuss that, but we're also going to discuss what happens if we just ring the bell, cash out, head to the sidelines. What does that look like for us? So I'm going to share some interesting data on what happens if you sell out of the market or miss the best days. So I hope you'll stick around for that. Get your mind right. Let's get to work. All right. Well, welcome back to the program, everybody. I appreciate you joining me once again after just a rocky, crazy week in the stock market. I know I sound like a broken record, but this past week we had the producer price index come out. We had the consumer price index come out, which are basically inflation measures, letting us know if inflation is rising, staying the same, or getting better. And based on this week, inflation is still very, very sticky. And I apologize if you hear some delays from me. I normally have two monitors, one with my recording equipment, one with the, I can pull up the market. Well, one of my monitors quit. And so I have a monitor that's going to be here next Tuesday. But of course, today I'm working on one, so I kind of have to minimize things. So if you hear a little bit of delay, that is what you're hearing. And then obviously my mouse. So when you look at the producer price index, it advanced 8.5% year over year. They were expecting 8.4. It is down from last month's 8.7. And then you look at the consumer price index, which is kind of what you and I are paying for things, and it was high again. So it was much, hotter than people expected. They're expecting that inflation is going to come down with all these rate hikes, and it just hasn't done so yet. And so the inflation rate was 8.2%, still very, very high. And so what that means is that it looks like the Fed's going to have to raise rates maybe 75 basis points again at their next month meeting. So that is November. And so we will see. We will see if they do that. It's starting to cause some problems around the world. And so these numbers that you get, the CPI, the PPI, are a little bit delayed. And so the worry is that they will continue to raise rates until there is something that breaks. And so if you look at the United Kingdom, Britain, they're having some issues with some of their pension funds and their bond market. And so it's pretty nasty. And so I titled this episode, Don't Ring the Bell, because I love watching and studying like Navy SEALs, reading about Navy SEALs. Some of y'all know Jocko Willink and his phrase of discipline equals freedom. And I love the discipline aspect of the military and soldiers. And, you think about there's not a lot of things you can control, but you can control your discipline. And so I was watching an episode or a video this week about Navy SEALs and the training that they do. So it's called the BUDS training, which is basic underwater demolition SEAL training, right? The SEAL training that you see, and you've seen this number of places where Navy SEALs have to go through SEAL Week. Or sorry, not SEAL Week, Hell Week. So they go through this intense week. That's not all Navy SEAL training, but they have like this Hell Week, and you can hear Admiral McRaven's commentary on this when he does the speech at the University of Texas, when he does the commencement speech. But he talks about how during the training there is a brass bell that you can ring, right? Anytime that it becomes too painful, you can ring the bell and be done. You can ring the bell and not have to wake up at 5 a.m. You can ring the bell, not have to be in the cold water. You can ring the bell, quit, and you can have a warm shower, you can sleep, you can have nobody bug you, you can have all these things. But if you ring the bell, you got to live with that the rest of your life. And I was thinking about the stock market this week, and I was thinking that you can also ring the bell in the market, right? You can sell anytime you want. When it gets too painful, you can sell anytime you want. And it's almost become a detriment to investors because you can sell so easily from your cell phone, your tablet, your computer. You can do it all your own. Used to, gosh, it's years ago now, 25 years ago, when we didn't have all this computer trading, you'd have to call your stockbroker, right? And you would have to have them sell for you, and it would cost you a lot of money because they got paid on commission. So every time you bought or sold something, you have to pay a percentage. So if you sell out of something, it could cost you $700 to $1,000, and now it costs you nothing to sell out. Right? So ringing the bell on the stock market is now the easiest thing possible for you to do. You can ring the bell at any time. You can sell out of your positions and you can be done. You can be done. And the problem with that is that when you miss good days, because we actually had a really good day this week, if you miss the good days, you really start cutting your performance down. So CNBC showed this earlier this week, and I've mentioned this on the podcast before, and it haunts my dreams. Well, it really doesn't haunt my dreams because I don't sell out, but I think about this and I think about the missed opportunity. So CNBC showed a little quip this week that shows if you invested $1,000 in the S&P 500 in 1970. And you left it invested until 2019, that $1,000 would have grown to $138,000. And that's without putting any other money in, right? That's without putting any other money in. Now, if you miss the 5 best days during that 49-year period of time, you would have cut your performance to 90,000. And if you would have missed the 25 best days, you would have cut your performance to $32,000. Isn't that just absolutely incredible? So you're really talking about, well, one of those is the best day every 10 years. And the other one is the best day every, 14, 15 months. And so you pair that with some other studies that have been done. And one of the ones I was looking at is when you look at, there's one that was done from January 3rd, 2000 to April 19th of 2020. So a 20-year period of time, how most of these are done. And six of the 7 best days they occurred directly after one of the worst days. So 6 of the 7 best days occurred after the worst day. So what ends up happening is somebody sells out, right? One day is so painful. At the end, they go, okay, I can't take this anymore. They ring the bell, they sell out, they're done. And then the very next day is a good day, and they go, oh man, I got to get back in. And so it is a hard emotion to pull back, or it's so easy for people to sell and get out that it really becomes a hindrance to their stock performance. And I know we've talked about it over and over and over again, but sometimes you just have to sit on your hands, and really you have to look at things. If you are purchasing a stock today, you have to be thinking that you're going to own it for at least 18 to 3 years. Sorry, 18 to 3 years. Jeez, 18 months to 3 years minimum. Like, why would you be buying something today if you didn't think you were going to hold it for the next 18 months to 3 years to ride some of this volatility out? And you don't have to buy it all at once. If you think you want to own $1,000 of something, buy it in pieces of $250. Or if it's 10,000, buy it in 2,500 increments, whatever it is. But you've got to figure out a way. Most of us, our worst enemy is ourselves, right? We betray ourselves because we don't have the emotional discipline to stick it out or to start investing or to do the things we said we were going to do. So you have to put in triggers that allow you to kind of bypass yourself. It's the reason that 401ks are so effective, is because the money is taken out before individuals actually get it, right? It's deducted from their check automatically. It automatically goes into the stock market. And so they don't allow you to take the money out without penalty until you're 59 and a half years old. So most people who are, let's say, 25, 40, 35, whatever it is, you're like, okay, I'm going to let it ride because I can't touch that money anyways, so I'm not even going to worry about it. And you don't look at it, and you start having better performance because you're not looking at it all the time and you're not touching it. So I thought that was a good analogy of the Navy SEALs, because you got to have that mental discipline. You have to be thinking about not what you're going through today, but where you're trying to get later on, right? I look at Amazon, and I know it's down. Earlier this year, it was $183 a share. I bought it this week for myself personally at $107. Now, again, I'm not your financial advisor. Talk to your financial advisor. Everybody's situation's different, right? So, but think about, I look at that and go, geez, I can buy one of the best companies in the world for a lot less than I could have bought it last year. And Amazon is a perfect example. That $183 that it was earlier this year really wasn't $183. That was when the stock was over $3,000 before they did their split, right? So there's a lot of individuals that could not have even afforded one share of Amazon last year that can now buy it at a substantial discount. And because of the split, they can afford it, right? $107. I mean, you can skip some lunches. You can make that happen, right? So when you think about, money is so emotional to people. But when you look at like Navy SEAL training and all this, I mean, these are individuals that are they're going to be in real danger. And so it always makes me feel a little bit better. Yes, finances are very important, but there are some real issues going on. You have to find some things that can kind of calm yourself mentally and allow you to think about the better days that are going to lie ahead once all of this stuff kind of passes. And so, at some point, inflation will come down. The Fed will have to stop raising rates. And when that happens, there's a lot of money on the sideline. The market is going to have some very, very good days. And if you're not on the dance floor on those days, you're going to be really upset that you missed out, because those are going to be the days that 10 to 20 years from now, when somebody's looking back at the performance of the stock market between 2020 and 2030, those are going to be some of the days that show up as the best days. And so even this past Thursday, the market was up 600-700 points, whatever it was. And it gave a lot of it back on Friday. But if you weren't invested in the market on Thursday, you cut your performance by a couple percentage points. And that's really all you need, because you really just need compounding to take over for you in the long term. And when you're thinking about long term, I still, going back to the Amazon example, there was a report this week by Baird that came out that showed, like, they surveyed 1,000 online shoppers, and they said, yes, they might spend less this year than they did the previous year, but 60% of them said that they were gonna shop on Amazon, right? That was their preferred e-commerce site. So they have a huge market share. And then also they looked at Generation Z and millennials, and they said overwhelmingly that was their most preferred place to shop, and that they set up automatic shopping features and all of these things. And so when you look at that, obviously later on, Generation Z, millennials, I mean, they're having kids, going to have kids. Like, those habits are sticky, right? They are going to continue to do that for years and years to come. And interesting enough, the online shopping piece of Amazon is not even the most profitable piece. It's Amazon Web Services, where their current CEO came from, and it was the most profitable piece of the company. And so now he's looking at the things that made Amazon Web Services so profitable. He's going to make Amazon shopping and all of those things more profitable for Amazon as a whole. He cares much more about profits for the company and cutting costs and things like that. And so I think you're definitely going to see Amazon's best years ahead of it. And for me personally, it's something I want to be a part of. So, take that for what it's worth. So now that we got this economic data out of the way, and honestly, man, when it's 2027, do you think you're going to remember what the CPI number was? I mean, probably because it was so high, but I mean, it won't be, when you're looking in the rearview mirror, you're not going to remember it too much. I mean, things like this do pass. But as we get rid of the economic data and now we start seeing earnings, right? So earnings season is starting. And so companies are going to get to tell their story. And so this past week, we had some of the banks start to do their earnings. We saw JP Morgan on Friday. We saw Wells Fargo on Friday. We saw Morgan Stanley. JP Morgan, Wells Fargo did pretty well. Morgan Stanley, not so much. Morgan Stanley, most of their revenue comes from investment banking. And so this has been one of the worst years for IPOs, which IPO stands for initial public offering. This is when companies become public and you can buy and sell shares of them. And in bad stock market years, especially the first one after so many good years, companies are like, no, I'm not going to go public yet. And so for Morgan Stanley, it really hits their bottom line. But I look at Morgan Stanley and I know that, okay, it's a bad year. It's a good company, pays a great dividend. I can buy that company at a low price. And when the IPO market comes back, they're going to have a really good year sometime in the future. And so just kind of taking the contrarian view and really just doing a little bit more homework. Most investors are going to be very surface level. They're going to get the low-hanging fruit, and they're not going to look at, really deep into what's going on. So looking at that, looking at what companies are going to report this week, I have a list here. Hold on. So Monday, we're going to have Bank of America. We're going to have Charles Schwab, kind of some of those. Tuesday, you're going to have Netflix after the close, which that one will be important. Netflix stock has been doing a little bit better as of late. And they just recently rolled out that they're going to come down on the price of their service if you're willing to watch ads. So an ad supported program. So the stock right now is $230. And last October, it was selling for $690. Jeez. So $690 a year ago, $230 today. That ad-supported service should help them gain more users. So we will see. I'm sure when they do their conference call, there will be more news about that. And so then later in the week, there's going to be AT&T, Verizon, American Express, all of these companies. And it's really going to be, okay, what was the quarter like for you? And then what do you see in the future? And that the companies speak about what they see coming in the next couple months is going to be key. So Jamie Dimon, he's the CEO of JP Morgan Chase, came out earlier this week. It's part of the reason the market fell earlier this week, talking about how he sees a recession in the next 6 to 9 months. He's been saying that over and over again. Depending on how you define it, we might already be there, but nobody wants to admit it. So we'll see how these earnings go this week, but hopefully if the numbers are good and the commentary is good, you should see the market stabilize a little bit. And then after this earnings season, because we have a lot of tech companies coming up in 2 weeks, and then we have the midterm elections, there is a lot of data that is coming out that can really gyrate the market. So you're going to have to be disciplined. You're going to have to be mentally disciplined, and you're going to have to think about the companies that you want to own and think about where you would want to own them and where you would add to your positions, because it is going to be mentally exhausting. And again, as I said earlier, You don't want to ring the bell on yourself. You don't want to sell things today, and not be thinking about how good of a company they are and how good their future is going to be, because you trick yourself into thinking that you're going to be able to get out and then get back in at the right time. So few people are able to do that. But it's constantly, we mentally think about that all the time. There's actually a bias called propensity for maximization. Boy, say that 5 times fast. So that bias says that when you look back at a chart, you go, man, if I would have sold here at the top and bought here at the bottom, I would be worth so much more money today. But it's very, very hard to do that. And really, nobody's ever been able to do it consistently. You might have some people who do it very well, somebody who sold out last November and now they're rebuilding their portfolio. I mean, it's you can do it, but it's not something that you can really do consistently. So the things that you can do consistently, you can stay disciplined about, those are the things that are going to take you to where you want to be financially, physically, whatever your goals are. It's the consistency that pays off. So the lesson for today, don't ring the bell. As painful as it becomes, you can trade around positions like we discussed. You can sell some when the market goes up. You can buy it back when it goes lower, but do not sell completely out. It is not a good formula for market, for leading market performance long term. It's just so difficult to do. Most of the best days happen within 2 weeks of the worst days. And so you have to stay invested. You have to stay on the dance floor if you want to participate in future gains. And so it's okay to take the pain today, knowing that you're going to have the benefits and reap the benefits in the future. There's an old Muhammad Ali saying that says, don't quit, suffer now, and live the rest of your life a champion. And so you have to be thinking about, when it's winter, you have to be thinking about the summer and the seeds that you plant today, what they're going to grow into later on, right? Warren Buffett says the best time to plant a tree was 20 years ago. So what you're doing today, the investments you make today are going to be the tree that you're under years from now. So keep that thought in mind. Keep the end goal in mind when you are going through painful days. Think about where you're going, not where you're at. And when you do that, it makes the volatility and the suffering that you're going through today much easier to think about. So think about where you're going, not where you're at, and it'll make it a little bit easier for you. So I hope this is helpful for you, and I appreciate you as always. If you have questions, send them in. We'll answer them. If you got specific stock questions, you can send those in. We will do our best to answer those on future episodes. And so we got some good stuff coming up. One of the things I'm going to highlight for you in a future episode is the big money managers, billionaires that I follow, and looking at what they are buying. I think that's going to be very surprising to you when you actually see what maybe some of the smartest people in the world are actually investing in. It's one of the main places I go to do research to see, what does somebody know that I don't know, but we'll delve into that at a future date. I hope you have a great week. Don't mistake activity for achievement. Don't ring the bell, and I'll see you next time.